So there's been a lot of big merger news in Canada lately that could really change the landscape for both consumers and businesses. So I wanted to aggregate some pretty important information that's less heard of for each of the two mergers, and some of my thoughts too. The first deal is Rogers and Shaw. This is a $26 billion deal for Rogers to acquire Shaw, essentially allowing the former to get much ahead of the competition in terms of revenues and number of subscribers. The $40 per share deal value represents 70% premium to the pre-announced Shaw stock price, and the expected closing date of the deal is the first half of 2022. Right now, the stock price is really far from the deal value since there's some concern from the regulatory side not approving it. In my opinion, the deal value is a bit expensive given that Shaw has been pretty stagnant at its valuation for years. And normally, the easiest way for mergers to make cost synergies is by slashing costs, aka letting people go. But Shaw already did that in 2018 by eliminating 25% of its workforce for restructuring purposes, and then again in 2020 by laying off another 10% for the pandemic. Furthermore, Rogers said that it wouldn't increase wireless prices for Freedom Mobile customers for at least another 3 years following the close of the transaction. I think a large proponent of what caused this deal to happen is that Shaw doesn't really want to compete and spend billions of dollars every year to build out future 5G networks across the country. It's also finding profitability hard because of lower pricing plans and weaker networks, which also make it harder to justify higher prices without scaring off customers. To add on to pains, the Liberal government is giving Canada's big three national wireless providers until 2022 to cut their basic prices for cell phone services by 25%. That means that many talk, text, and data wireless phone plans will be under $40 per month. But if the big three don't do anything about it, then the government will step in to cut prices if they don't comply. The price reduction would make it even tougher for Shaw to compete, since those reduced phone plan prices would land in their discount territory. So essentially, I think the premium deal price is more so reflecting what Rogers is willing to pay to remove a competitor in the telecom race, rather than make money through operational synergies. Also, given that Rogers plans to spend more capital investment over the years on its 5G network following the business combination, I think it will be a challenge for them to make back their money on this deal, since there's a lack of benefits from raising prices or slashing costs through immediate headcount reduction. But I also think other possibly more constructive ways that Rogers could have used $26 billion would be a combination of either increasing their dividend to that of a 5 to 6% dividend like their peers, buying back their own stock, optimizing their own operations to grow organically, or investing in the stock of US communication companies, where they could be the ones in the position of collecting a nice dividend or having strategic partnerships. Overall, I think this is an excellent deal for the Shaw family, who currently have a controlling interest in the company. It gives them a golden parachute exit out of a business I think that they're tired of being a part of, and now they can theoretically take all that capital to invest in either highly liquid stocks or in other higher growth investment areas. But it's also possible that the Shaw family has intentions to be a large shareholder of Rogers if they want to stay in the game. Likewise, this is also a fair deal for Rogers since they become allies with one of its competitors and they have an even stronger competitive position and subscriber base against Bell and Telus. On a side note, given a unique relationship dynamic, I wouldn't be surprised if a similar merger deal arose in the future between Rogers and Quebecor since they have network sharing agreements and Quebecor is a sizable company at around half the deal price. And to show you what I mean in terms of a change in the Canadian telecom power dynamic, here's a high-level overview of how many subscribers each of the 5 big players have in Canada. The big three are very close in competition, with Rogers taking the lead on wireless phones and Bell for cable TV and internet. Shaw and Quebecor are pretty far behind since they are newer to wireless. Now here's the same table with Rogers and Shaw combined together. The combined entity now has a much higher place on the food chain in all telecom areas. Now I doubt regulation passes this merger without a load of divestiture requirements, because this would give too much monopoly concentration to Rogers, and right now the current wireless ecosystem supports newer entrants like Shaw's Freedom Mobile and Quebecor's Videotron to lower phone plan prices in the country through more competition. We saw a similar setup with Manitoba Telecom being acquired, and there was a mutual agreement for the assets and subscribers to be split 3-1 between Bell and Telus, instead of it being fully acquired by a single company. In this case, Freedom Mobile could likely be split up amongst other players. If not, I also see Telus probably making an attempt to buy Saskatchewan Telecom, a Crown company, in order to preserve its dominance in Western Canada against the final majority owner of Shaw Communications. As a comparison for pricing, Canadian phone plans are on average 20 to 40% more expensive than the US phone plans of the same offerings, and it's also apparently 50 to 100% more than other G7 nations around the world. So there's real intentions and support for newer telecom entrants around the world to come in and compete to bring those prices down. Last year, Cogeco turned down Rogers for their takeover offer of $11 billion and has expressed interest to compete in the wireless space as well. There have been long talks of US telecom companies coming to Canada after Ottawa in 2013 allowed out to 20% foreign ownership of the Canadian telecom companies. With little change in prices in Canada, I can see Ottawa removing more foreign ownership walls. This would make pricing more competitive, but the American companies would have to start from scratch since they don't own anything in Canada. So acquiring an existing smaller player would be the most tactical move. Otherwise, leasing infrastructure from the big three would be the other less attractive option. Unfortunately, moves by US telecoms never materialized, with the latest moves by Verizon having explored an acquisition of Wind Mobile back in 2013 prior to it going to Shaw Communications. Verizon was a top contender since it used to be a big owner of BC Tel, which later became part of TELUS. Starlink, launched by the US by Elon Musk through SpaceX, is trying to override the land-based cables and poles and uses thousands of mobile satellites to deliver wireless directly to consumers, thus bypassing the big three. In October 2020, the CRTC granted a preliminary license to Starlink to proceed in its operations, although it's not yet allowed to operate as a carrier or internet service provider. Now, Starlink is apparently available in rural parts of Ontario, BC, Alberta, Manitoba, Saskatchewan, and New Brunswick, so the Canadian telcos are rushing to stay competitive as they ramp up their expansion in underserved areas in Canada. This was actually a highlighted expansion topic for Rogers following the announcement of the Shaw deal, so we'll see how that plays out. According to Starlink, they're looking to roll out its beta service with near global coverage of the populated world in 2021. Canadian Pacific Railway and Kansas City Southern. This is a $25 billion deal for Canadian Pacific to acquire Kansas City Southern, which is the fourth largest publicly traded railway in the US. The name of the combined company will be called Canadian Pacific Kansas City and would close in mid-2022 if approved. The $275 per share deal value represents almost a 25% premium to its pre-announced price. Unlike our previous deal with Rogers and Shaw, I think that this deal value was much more appropriately priced and really adds more operational benefits in terms of a larger and more efficient rail network to do business across the continent. The combined 32,000 kilometer rail network would be the first rail to connect Canada, US, and Mexico, whereas the other large rail, Canadian National Railway, is also 32,000 kilometers but is only within North America. This deal likely comes as a result of the newly formed US-Mexico-Canada trade agreement, aligning more efficient trade in between the three countries, as well as tougher regulations by Biden on Canada's Keystone XL oil pipeline, which connects down south. Revoking the Keystone Pipeline's permits on concerns about climate change has made delivering crude oil from Alberta to various US states more difficult, so more relief by rail delivery was definitely a consideration. Currently, crude by rail represents 5% of CP's revenues and 2% of Kansas City's. Rail is 4 times more fuel efficient than trucking, and one train can keep more than 300 trucks off public roads and produce 75% less greenhouse gas emissions. So besides oil, rail is definitely going to be an even more competitive and environmentally friendly way to transport products across the three countries. Products like grain, metals, retail products, and automobiles. CP's rail network currently looks like this. It mostly goes horizontal across Canada as well as some entry in the middle of the US. Kansas's network focuses in the middle of the US and drives all the way down south to the Gulf of Mexico. When put together, the network nicely connects to all three countries in a T shape. Likewise, here's CN's network. It looks like CP's spanning horizontally across Canada, plus the track down to the middle of the US, but it misses the additional connection to Mexico. Does the deal mean that CP will dominate the Canadian rail competition over CN? I don't think so. When all is said and done, the bulk of the Canadian rail business is within North America. The combined CP Kansas entity will have a revenue mix that's only 14% from Mexico, or roughly $1.5 billion, and CN still has 50% more total revenues than CP, even after the deal closes. However, going forward, if businesses have more activity in Central America, particularly those in grain, energy, merchandise, and automobiles, then they may find themselves doing more transport with CP if it becomes a more cost-efficient route. Here's all the Canadian and US railways side by side showing their current market capitalization and revenues in US dollar. Burlington Northern is private and owned by Warren Buffett's Berkshire Hathaway, so there's no market cap. Interestingly, this would be the first takeover of a North American railroad since Warren Buffett made that purchase for BNSF for about $36 billion during the last financial crisis in 2009. Currently, CN is the largest rail in Canada by size and revenue, making it comparable to some of the largest US rails. But when you combine both Canadian Pacific and Kansas City together, then it becomes much more comparable in size, although still much smaller. Here's a quick highlight of the US rails networks. Union Pacific's looks like this with coverage in the lower middle and west end of America. Burlington Northern looks like this with coverage mostly in the middle, with some in the west end as well. CSX's looks like this with coverage in only the east end of America. Likewise, Norfolk Southern's looks like this with similar east end coverage. You'll find that Kansas City was the only rail with a clear direct line connection to Mexico, which makes this deal with CP very unique for the rail industry. But as great as this deal might be, failure of the deal would mean that CP has to pay Kansas City Southern a $1 billion reverse breakup fee, which represents roughly 4% of the deal value and 40% of CP's operating profits. There have been some failed attempts in the past for mergers in the rail space. 2 decades ago, Canadian National tried to buy BNSF but was blocked by US antitrust authorities. In 2014, Canadian Pacific had tried to enter into a merger with CSX but was rejected and unsuccessful. In 2016, Canadian Pacific also tried a hostile takeover of Norfolk Southern for $28.4 billion that mostly failed because of antitrust concerns. Even recently in September 2020, Kansas City Southern rejected takeover offers from global infrastructure partners of up to $23 billion, despite the COVID-19 pandemic. The company argued that the bid undervalued the rail operator. Although these past transactions indicate some risk to the deal happening, what gives me hope at least is that this is a friendly merger between two companies, as well as strong support by both shareholder bases. There are clear economic and environmental benefits for the operations to be combined together, and their businesses combined are still small enough to not even be close to being classified as a monopoly, and antitrust concerns would be less scrutinized. So that's all for now. If you enjoyed this video, remember to like, subscribe, and turn on your bell notifications for more Canadian investment topics in the future. Let me know in the comments below your thoughts on the Rogers Shaw and CP Kansas deals, and I'll see you next time.